Hello and welcome back to our channel. In today's video, we'll discuss the importance of a stop loss order and the difference between that and a stop limit order when buying stocks from a broker. Both types of orders can help you manage risk and protect your investments. But there are some key differences you need to know. What is a stop loss order? A stop loss order is an instruction to sell a stock if it falls below a certain price. When you place a stop loss order, you are essentially setting a limit on how much you're willing to lose on a particular investment. If the stock price falls below your specified stop loss price, your broker will automatically sell your shares at the next available price. Example, let's say you buy 100 shares of XYZ company at $50 per share, and you place a stop loss order at $45 per share. If the stock price falls to $45 per share, your broker will automatically sell your shares, limiting your loss to $5 per share. What is a stop limit order? A stop limit order is an instruction to sell a stock at a specified price or better after it falls below a certain price. When you place a stop limit order, you are essentially setting both a stop price and a limit price. If the stock price falls below your stop price, your broker will automatically place a limit order to sell your shares at your specified limit price. Example, let's say you buy 100 shares of XYZ company at $50 per share, and you place a stop limit order at $45 per share with a limit price of $43 per share. If the stock price falls to $45 per share, your broker will place a limit order to sell your shares at $43 per share. If the stock price falls further and reaches $42 per share, your shares will not be sold. Key differences. The key difference between a stop loss order and a stop limit order is the price at which the trade is executed. With a stop loss order, the trade is executed at the next available price after the stop price is triggered, which may be lower than the stop price. With a stop limit order, the trade is only executed if the stock reaches the specified limit price or better. Another important difference is that stop loss orders can be triggered quickly in volatile markets, while stop limit orders may not be executed if the stock price falls too quickly or the limit price is not reached. That's all for today's video. Thank you for watching, and please don't forget to like and subscribe to our channel for more content.